The promise appearing across social media is remarkably consistent. Invest $1,000 today and watch it multiply into $10,000 or $20,000 by 2026. This narrative thrives on the fear of missing out. It creates the anxiety that others are securing generational wealth from the artificial intelligence boom, while you remain on the sidelines. Financial influencers regularly highlight Amazon, Microsoft, Nvidia, and Tesla as the primary vehicles for these 2026 returns. This leaves many investors in a difficult position. They want to participate in the AI revolution, but they are equally concerned about buying these specific stocks at the absolute peak of a hype cycle. Making decisions based on that anxiety hides a significant reality. There is a massive gap between a company developing a successful technology and a stock that actually has the mathematical room to grow exponentially. We can analyze this gap by looking at market capitalization. Market capitalization is the total dollar value of all a company's shares of stock, representing what the market believes the entire business is worth today. This chart compares high growth expectations against the reality of how massive companies scale. The left side shows why the 10 times multiplier is so difficult for a mega-cap company. If a business is already worth $3 trillion, multiplying its value by 10 would make it larger than the gross domestic product of almost every nation on Earth. The right side illustrates what trillion-dollar growth actually looks like. It is steady, incremental compounding driven by existing dominance, rather than the explosive spikes seen in small-cap startups. For these specific tech giants, the period of rapid, multi-bagger returns has likely passed. Buying them today provides exposure to market leaders, rather than a path to an overnight fortune. Amazon and Microsoft function as the foundational landlords of the digital economy through AWS and Azure. AWS and Azure are cloud computing platforms that provide the storage and processing power required to run modern enterprise software. This chart plots tech players by risk and reward. Microsoft and Amazon land in the quadrant for high predictability and moderate premium. This provides exposure as corporations migrate to cloud servers. However, near monopoly positions mean limited upside, aligning growth with broader sector averages. Their strategy involves integrating AI directly into ubiquitous tools like Microsoft Office and Amazon's logistics network. This creates a wide economic moat, a structural advantage that protects their existing revenue from smaller competitors. Buying the cloud giants is a defensive AI play. It prioritizes the stability of the infrastructure providers over the volatility of the companies building new, unproven applications. Nvidia occupies a different niche as the primary hardware provider making the AI build-out physically possible. They design the graphics processing units, or GPUs, residing in global data centers. These chips process the data required to run large AI models. Buying Nvidia provides a stake in the company that currently manufactures the vast majority of the world's AI training hardware. Our quadrant chart places Nvidia in high predictability but an extreme valuation premium. Accessing this requires paying a price assuming zero future manufacturing delays. If corporate AI spending slows even slightly, this high entry price makes the stock susceptible to a sharp decline. Nvidia is the most direct way to play the hardware boom, but it carries the mathematical risk of a valuation correction if the current pace of infrastructure spending cools. Tesla stands apart from the predictable software and hardware pipelines found in the rest of the sector. Its revenue currently comes from vehicle manufacturing, yet its stock price is driven by expectations for autonomous driving and robotics. On our chart, Tesla is isolated in the quadrant for low predictability and a high premium. This stock offers exposure to high-ceiling markets like energy storage and robotaxis. The trade-off is extreme price volatility, relying on unproven technologies and unpredictable regulatory approvals. Among the megacaps, Tesla behaves as a high-risk venture capital investment, currently trading with the liquidity of a blue-chip stock. This leads to the central question: how can you build a position in these companies without the risk of buying exactly at a market peak? One approach to managing high entry prices is dollar cost averaging, or DCA. This is the practice of investing a fixed dollar amount into a stock on a regular schedule, regardless of its current price. Consistent, smaller investments help smooth out market volatility. You naturally buy fewer shares when prices are high and more shares when the market dips. This strategy requires significant patience. It forces you to ignore the rapid wealth narratives often promoted online in favor of a long-term plan. Long-term growth relies more on surviving market cycles and allowing interest to compound than on trying to identify a single undiscovered asset. When you are dealing with companies valued in the trillions, the mechanics of your investment schedule are more important than the exact day you enter the market. We can now conclude by matching these market realities with your specific financial goals. This scorecard categorizes who should and should not be allocating capital to these stocks today. The long-term pragmatist column shows the most viable path. These stocks are suited for those seeking foundational, cash flow positive monopolies who are comfortable with realistic compounding over 5 to 10 years. The FOMO beginner column carries a warning. Expecting a small investment to turn into $20,000 via these specific trillion-dollar companies by 2026 is mathematically unfeasible. The AI boom is a real economic shift. However, the explosive 1,000% gains for these specific household names were largely realized over the previous decade. Optimizing your portfolio requires looking past the hype and aligning the actual size of an asset with your genuine financial timeline.